Well, here in Australia, a common mortgage term is 30 years. And if you follow the bank's minimum repayments over that 30-year term, a $600,000 mortgage at 5% interest is going to cost you over $1.15 million over the 30-year term. That's $559,000 in interest, almost as much as the mortgage itself. Well, when it comes to mortgages, here in Australia, interest is calculated daily and is compounded. Now, as an investor, if you've got money sitting in an investment account and it's compounding, that works for you. That is great. You want that. But for a mortgage, this is going to work against you. Firstly, you want to be able to pay the mortgage off faster. You want to offset the interest on the loan as much as possible so that the money works for you, and by keeping these funds offsetting the interest for as many days as possible. As I mentioned before, interest is calculated on a daily basis. So the more money you can have in the loan, redraw, or the offset account, sitting in there compounding against the daily compounded interest, that's going to help you minimize interest over the loan term and help you pay that mortgage out faster. The two, as I mentioned, offset and redraw. An offset account is an everyday bank account that's linked to your home loan, which you can deposit your salary and savings into that account, and the balance is then offset against the amount owing on your home loan. A redraw facility lets you access extra repayments you've made on your home loan. Maintaining an available redraw balance can help you reduce your interest on your home loan. So here's how you can structure your finances to pay your mortgage faster using an offset and a redraw. So with the offset, you're going to have the home loan account itself, and you're going to have the offset account that's linked. So the way you'll structure it is that your salaries will get paid directly into your offset account, and your bills, expenses, and mortgage repayment come straight out of that same offset account. The key here is to stick to a budget so that you have some excess funds at the end of the month. Now, instead of putting those excess funds into a separate savings account where it's barely going to earn any interest for you, what you can do is put those excess funds directly into your loan redraw, which your loan account should have, even when you have an offset account set up. And this can offset the interest of the loan. Not only is it offsetting by the money you've got in here, but also as you're building up that redraw and putting in your excess funds into the loan account every single month. Now, if there are emergency situations, the loan redraw that's sitting in this loan account is easily transacted straight out back into your offset account by logging into your online net banking. A home loan that has no offset and it's just a loan account with a redraw, what you'll find is generally these loan accounts have less fees associated with them and also generally lower interest rate than packages with offset accounts. So you have the added bonus there of having a cheaper mortgage. Now, there are some banks where you can deposit your salaries directly into the loan redraw itself. When people set up this structure, one way they live off their everyday living and expenses is they live off a credit card. Now, you've got to be careful here because you've got to be able to stick to your budget and not overspend unnecessarily. The beauty about this is that for most of the month, your salary is sitting in that home loan and it's offsetting the interest of the mortgage. This is how you're able to pay that mortgage off faster because, as I mentioned earlier, the amount that's owing on your mortgage, the interest is compounded every single day. So the longer you can have excess funds sitting into that and building, the less interest you're going to pay and the faster you're going to pay out that mortgage. Here's how the redraw example looks in a bit more detail. So this here is the bank's amortization schedule where, as I said earlier, if you're paying monthly over 30 years, this is that schedule that you'd be following. Now, by utilising this redraw example, what's going to happen is your salary is going to come in. So let's say it's $10,000 in the month that gets deposited into your accounts. $10,000 gets popped into the mortgage right away. So if there's a minimum repayment of $3,000, you're actually ahead $7,000. Event 2, the mortgage repayment comes out. It can come straight out of that redraw. And event 3, at the end of the month, you pay out the credit card. So what's going to happen is the mortgage balance first drops, then it slowly comes up. Now, at the start of the next month, you're starting at a lower point than you were previously. The salary gets dropped straight into the mortgage. Again, $10,000 gets dropped in where the minimum payment is only $3,000. So again, you're $7,000 ahead. A week or two later, the mortgage repayment comes out, and then at the end of the month, you pay out the credit card. which is what all your living expenses were off. Now you can see here why it's important to be careful with your spending on your credit card and sticking to a budget, because if you let that blow out, that can go straight back up and take away all of your redraw. The key here is to stay disciplined so that you can keep compounding on the amount that's sitting in the mortgage and offsetting against the interest. And the next month comes in, salary goes in, expenses come out. Third month comes in, salary goes in, expenses come out, and so on and so forth, which is what accelerates the process of you paying out that mortgage faster, because you constantly have all of your funds sitting in that home loan, and only a couple of times a month there's a smaller amount being taken out to cover the mortgage and the credit card repayments than there is going in via your salaries. Just to recap, if you follow the bank's amortization, their monthly repayment schedule over 30 years, a $600,000 mortgage at 5% interest is going to cost you a total of $1.15 million for $559,000 in interest over the term. Now, if you want to pay it off faster and you're able to pay $500 a month excess into that mortgage every month, you're going to save $162,000 in interest and pay your mortgage off in 22.5 years. At $700 excess a month going into the mortgage, that's $202,000 in interest saved, and the mortgage paid off in 20.5 years. $1,000 a month, you're going to save $247,000 in interest and pay the mortgage off in 18 years. If you can put $1,500 a month extra into your mortgage, you're going to save over $300,000 in interest and pay the mortgage off in 15 years. That's half the original term. If you like this video, please like and subscribe and share with a friend who can also benefit from this info. See you next time.